Why do most Singaporeans let their CPF money sit at 2.5% when some REITs here are quietly paying out twice as much and the outlook keeps getting brighter for 2026? Today, I'm Iggy from the Investing Iguana, and I'm about to break down the three S-REITs that look set to ride Singapore's wave of rate cuts right into a dividend upswing next year. If you want your cash working harder, stay tuned. This video's for you. Just so you know, you're in good hands. Iggy here, ranked number 8 in Tiger Broker's 2024 Influential Tigers, over 1 million reads, 58,000 likes, and more than 1,000 finance videos, clocking over 600,000 watch hours. Plus, I'm obsessed with linking what's happening regionally and globally to practical moves for Singapore investors. You're watching the Investing channel for smart local money. This video is adapted from my latest in-depth Substack deep dive. Here's our roadmap. We'll start with the actual problem that Singapore investors face, then unpack why interest rates matter more than you think. We'll walk through the three REITs set for a 2026 dividend upswing: Capitaland Integrated Commercial Trust, Frasers Centrepoint Trust, and Mapletree Logistics Trust. We'll compare CPF rates and REIT yields and tackle how you should position your portfolio for next year. As always, I'll give my personal take at the end, then recap and invite you to join our membership community. Let's jump right into the heart of the issue. Picture this. You open your CPF statement and see that regular 2.5%, nothing to write home about. Meanwhile, news headlines say Singapore REITs have bounced back nearly 9% since July. What changed? The answer is interest rates. The 10-year Singapore government bond yield fell from almost 3% at the start of the year to under 1.8% by September. That shift means REITs are cutting their debt costs, which could put real cash in your pocket through rising dividends. Think about it this way. When a REIT borrows at 4% to buy a property yielding 6%, the profit margin looks healthy. But if borrowing costs go up, that margin shrinks. In 2024, rising rates squeezed REITs hard. Now the tide's turning. We're expecting another 1.25% in Fed rate cuts in the next 6 months. For REITs, refinancing older loans at these new lower rates means more profit out of each building, and hopefully more for investors like you. Quick visual. Imagine a table with bond yields dropping, average REIT debt cost gently sliding down from 3.7% to 3.6%, and sector index yields sitting near 6%. The money REITs save on interest could be passed on directly as dividends. Want the full table? Grab this post on Substack, link in description. So which REITs are best poised to ride the 2026 wave? 3 names stand out, each with a different story. First, Capitaland Integrated Commercial Trust. This REIT is like the team captain of Singapore real estate, owning icons like Ion Orchard and Plaza Singapore, and now 100% of Capita Spring. In the first half of 2025, CICT's DPU grew 3.5% thanks to a big contribution from Ion Orchard, and retail rent reversions hit 7.7%. That means tenants renewed their leases at higher prices, a sign the malls have real pricing power. Here's how you'd see it in a chart. CICT's DPU rising, occupancy hovering at a healthy 96% plus, leveraging below 40%. And recent asset picks like Capita Spring adding immediate growth. Imagine steady upward lines, lots of green and positive captions, tables that tell you the momentum is powered by Singapore's thriving retail and office scene. CICT's portfolio is 95% Singaporean properties, a direct play on our economy, our shoppers, our offices. With new debt coming in cheaper, CICT's DPU forecast for 2026 is $11, with more upside from future acquisitions. Now to Frasers Centrepoint Trust. If CICT is your high flyer, FCT is the reliable friend. Steady, local, and everywhere you go. FCT owns 9 suburban malls, buzzing with daily foot traffic. Defensive, but with a hint of upside as Singapore's SG60 vouchers put extra spending power in shoppers' hands this year. FCT's DPU for the first half of 2025 nudged up 0.5%, but behind that number is 9.5% occupancy. Tenants don't want to leave. The REIT's balance sheet is rock solid, gearing at 37%, and most debt locked at good rates. For the cautious investor, stability is the name of the game. The 2026 DPU forecast, $235. These are the kind of numbers that build wealth quietly. Picture a table comparing mall occupancies, a near-perfect lineup, gearing ratios well below risk territory. Want the full breakdown? Substack's your place. Mapletree Logistics Trust tells a different story. MLT's yield sits at 6.3%, the highest of the group. But some pain comes with that higher payout. Its China operations struggled and overall occupancy fell to 91%. But here's what got my attention. Management is recycling capital, selling underperforming assets and switching into stronger markets. Excluding China, rental reversions are up 2.8%. If you think Asia's logistics sector can shake off its headwinds, MLT is a high-risk, high-reward candidate for recovery. Table-wise, you'd see falling DPU on one side, stabilizing gearing, and a big chunk of loans waiting to be refinanced. It's not all rosy, but the full story is in the numbers. Let's talk CPF. Your OA earns 2.5%. Special accounts lock in 4%. These are superb for your retirement safety net, but for money outside CPF, REITs offer a clear path to higher yields. Visual. Imagine a comparison table. CPF OA at 2.5%, special account at 4%, CICT at 4.7%, FCT at 5.2%, MLT at 6.3%, SR index at nearly set. The risk and growth potential climbs as you move right, but so do the possible returns. Here's the thing. CPF accounts are your bedrock, but they won't make you rich. If you got excess cash in the bank or have maxed out your CPF allocations, S-REITs could be your next growth engine. 2026 looks different. Here's why. Global rate cuts are coming, rental markets in Singapore are strong, and asset enhancements, like CICT's full Capita Spring takeover, are driving up the numbers. Sector tables show retail and office REITs looking sharp, industrial and high-yield names facing more uncertainty. Want all the nitty-gritty tables and full strategy checklist? Check out the written post on Substack, link below. It's got everything in detail. Let's recap the risks. If the economy slows or if rates reverse, some REITs could be hit. Industrial oversupply is real, especially for MLT. REITs are not guaranteed machines, and recent rallies may already price in some optimism. Execution matters. Diversify, size your bets right, and stay long-term focused. My personal take, as someone who stared at Singapore market screens since the last MAS policy update. If you're conservative, FCT is your anchor. For more growth, CICT's momentum is hard to beat. MLT suits those who want high yield, but be ready for volatility. I'm holding all three, each for a different reason. Singapore's market is showing real signals of resilience, and 2026 could be a turning point for S-REIT income investors. What's your biggest challenge? Finding safe yield, timing your entry, or just riding out the cycle? Drop your thoughts in the comments. Maybe it sparks the next community episode. Before we wrap, here are the actionable lessons. Pick the REIT that fits your risk style. CICT for growth, FCT for safety, MLT for yield. CPF forms your foundation. REITs are the next layer. Dollar cost average your entries. Don't chase short-term pops. Reinvest those dividends, and tax-free distributions compound even faster. Always monitor sector trends, rate cycles, retail spending, and property supply. If this guide was helpful, smash the like button, subscribe for weekly market insights, and join our Investing Iguana membership for full access, including monthly deep dives and exclusive investor call-ins. Check the video description for the Substack link to the written playbook and all full charts and sector tables. For continuity, check out my next video, How Interest Rate Cycles Move Asian Property Stocks. Your CPF works hard, but your portfolio can work harder. Stay invested, stay curious, and I'll see you next time.